Well, second quarter earnings season is well underway, and big tech giants Amazon and Apple, they are set to report their latest financial results later this week. So far, tech earnings have matched the hype. This quarter, there's a big emphasis on advertising spend and euphoria surrounding generative AI. But with Wall Street bullish on tech again, investors are wondering just how long market momentum can last. For more on the tech industry, we're joined by Mona Mahajan, who is the Edward Jones Senior Investment Strategist. Mona, great to have you here with us this morning. Let's start there in this larger kind of tech trade and the focus on tech that we've seen, especially coming into this earnings season with some of the larger trends here. Is, from your perspective, tech delivering on expectations, and what does this set up for later this week?
Yeah, it's a great question. And look, the NASDAQ is up over 35% year to date. Clearly, technology broadly has had a great run already. Now, what we would say is this is a pretty nice setup for tech broadly, and especially large cap tech. Not only are you seeing inflation trends move lower, interest rates over time potentially moving lower, but we're also seeing a lot of these large cap tech companies have free cash flow available. So they don't have to go to the markets or banks to borrow at these higher elevated levels of interest rates. So this is a good setup for large cap tech broadly. And then, of course, you have the cherry on top, which is the start of what we think is a secular bull market in generative AI. We are, of course, seeing that reflected in the markets in a very quick manner. What we would say from a trading perspective, these stocks have run very far, very fast. Would we expect a period of consolidation, some profit taking, perhaps a pullback? That is, of course, a natural part of any sort of business cycle and market cycle. But what we would say is, for those that haven't positioned in technology after this, or maybe missed the first half of the year, any kind of period of volatility we think is an opportunity to position for this longer term trend. Now, valuations are on the stretch side. So we do think that waiting for better opportunities could be interesting here. But we do think that the trend is here to stay. And we think that the backdrop will be favorable in the months ahead as well.
Mona, it's Julie here. It's good to see you. What about valuations, though, for these tech firms? Because, yes, you can look at the sort of longer-term generative AI story, but in the meantime, these guys are expensive. Does it just not really matter right now? It hasn't seemed to matter for a while.
Yeah. Look, I think the growth trade was the one that worked for the first half of the year. As we look towards the back half of the year and early into 2024, where we are seeing better valuations is in what we're calling the S&P 493, outside of what we're saying the Magnificent Seven, or the 7 large cap tech trades that have really led the rally thus far. Now, valuations, for example, in the 493 are about 16.5 times forward PE versus about 30 times in the Magnificent Seven. So you're seeing this discount in the rest of the economy and the rest of the market. So where we do think, one of the key themes will lie over the next 12 to 18 months is a broadening of leadership. And so, and that could probably be driven by an economy that's holding up better than expected, a Fed that's potentially moving to the sidelines. But where we do think you want to be positioned is a balance of not only the tech trades, but you want to make sure you have exposure to areas that do perform well in a recovery environment. That includes cyclical sectors like industrials and materials. That also includes small cap stocks, which have started to show leadership as well. So to your point, technology does deserve a part of your portfolio, but really you want to make sure that the theme of your portfolio for the next 12 to 18 months is balance, and making sure you have some of the cyclical parts of the market, even international and small cap, as we noted, good places to be as we go through the rest of this cycle.
Mona, we've been looking for bellwethers out there, and this week perhaps we have even 2, but from your perspective, is there a bigger bellwether in terms of this earnings season? And we've got Amazon and Apple to both kind of put into that conversation and into sight.
Yeah, thus far this earnings season has delivered, similar to the first quarter where we came into earnings season looking at very negative growth rates. I think we came into this earnings season looking at about -9% or so. We're about -7.5%. 80% of companies that have reported thus far have beaten on bottom line, so margins are holding up better than expected. And as we're looking through full year earnings, in fact, the S&P earnings growth for this year, it's now slightly positive. It had dropped to slightly negative. So, not stellar earnings, still about flattish for 2023. What we think is really interesting for earnings is 2024. And thus far, expectations are for a rebound in 2024. In fact, to double-digit levels, so about 12% expected in 2024 earnings. So you're looking at a backdrop where earnings could grow, inflation could moderate, as we noted, and the Fed could not only step to the sidelines, but perhaps start thinking about rate cuts next year. So that's an environment you want to be positioned for as we're heading towards the back half of this year. And again, periods of volatility, whether it's around earnings or otherwise, we think that is the opportunity then to position, especially as there is a lot of money still, we think, sitting in shorter duration CD cash-like instruments that has yet to be deployed into the markets. And so there's an opportunity, we think, still ahead of us.
Right. And we'll see when that starts to sort of tip over or pivot, if you will.